Hello everyone and welcome to the second of our finance webinars developed as part of the Money Matters series. My name is Aileen Deasy, Manager on the Enterprise Development team, and we are delighted to bring you this really important finance webinar today. So thanks a million for taking the time, and great to see a lot of businesses taking part in this today. So this is a really important area for all businesses as we move from survival to recovery. We are acutely aware of the challenges that you've been facing with rising costs and the impact of all of this on the bottom line of your business. So therefore, to help you navigate the current financial environment, this webinar is focusing specifically on managing your cash flow and repairing the balance sheet. So we're absolutely delighted to be joined by our two experts today from Crowe. So we have Maria Doyle-Balfe. So Maria is Director of Hotel Tourism Leisure in Crowe and has over 20 years experience in industry and consulting experience in the hotel sector, also in tourism and leisure industry. She has held senior management positions in the hotel sector and the tourism sector, and has an in-depth knowledge of this sector, both operationally and financially. Aidan then is a partner with Crowe, working in the corporate finance department. He is a fellow of Chartered Accountants Ireland and a member of the Representative Committee of Restructuring and Insolvency Ireland. So Aidan's expertise is particular in relation to debt financing, business liquidity, cash flow management, capital appraisal decisions, and strategic business planning. So we're in good hands to talk about this very important area today, and I'll hand over to you now, Maria.
Thanks, Aileen, and I think we'll get started. So the topics that we thought we would cover today, we are going to look at a number of different areas. First of all, I think we want to give some context to where the environment is, and it's really important to look at your external environment, particularly when you're doing your budgets and forecasts. So we're going to just have a look at a number of items there. Then the implication for the type of operation, because there's obviously very different types of activities throughout Ireland. We're going to look at a scenario of what an activity P&L looks like, the impact that the last 2 years have had on its balance sheet, and then moving forward, what will be the impact on its cash flow for the next couple of years. And then really a discussion on managing cash flow and what's next. Okay, so going straight, I think, into the market overview. We have a number of bullet points here, Aidan. Maybe you might talk us through these and how the impact will be for the activities sector.
In terms of, I suppose, post-pandemic economic recovery, like we're into a year of strong rebound, I suppose, for these businesses. And when I talk to these businesses, they are concerned as to, how quickly will their business return to 2019 levels. I think they recognize the world is a very different place. The cost base they have in 2022 is different to what they had in 2019. And therefore that's going to impact on their profit. And the question is, well, how quickly can they recover revenues? How can they manage costs? And how can they recover profit levels back to 2019 levels? And that's very challenging, I suppose, because of the supply chain disruptions. So if we take three costs, I suppose, in terms of labor costs, we know that they're up significantly. There are shortages in that area because a lot of these businesses closed and had to reopen. Energy costs have been up 20–30% in 2021, up something similar in 2022, and therefore, I suppose, these cost increases are much greater than the, I suppose, pricing, I suppose, improvements that can be got by these businesses. Equally, any businesses that have an association with the leisure market, insurance costs are going up by, I suppose, double-digit amounts, and can be hard, I suppose, to attain insurance, and therefore very hard to get a good quote on that. Mentioned energy, I suppose, and really what the Ukraine-Russian war, I suppose, is probably telling us is that energy costs will stay high for the next 2 or 3 years, because we're going to have that supply-demand, I suppose, imbalance, as I suppose there are kind of tariffs or embargoes against, I suppose, Russian oil and gas. And those, I suppose, higher energy costs are not only, I suppose, impacting on the businesses themselves, but equally on their customers. The customers are changing their daily lives in terms of how much energy they're consuming. So they're looking to, I suppose, outlets and businesses that are supporting as to what are they doing. There's a greater awareness on that. But equally, I suppose there's a role within the business in terms of reinvestment. How do we reinvest, I suppose, the profits that we have in the business? And I think there's a bit of capital rationing and looking at projects that will, I suppose, reduce costs into the future, especially, I suppose, invest in initiatives that will save on energy.
Okay, thanks. And I think that's, those are all valid points. Certainly make for a very challenging environment this year, and I think for a couple of years going forward. But I think your point is really to take these into consideration when you're doing your budgets and your forecasts. So I suppose one of the other things that we want to look at is demand. Like obviously the domestic tourist has been really positive for Ireland as a whole for the last 2 years, and the expectation is, we're not back to 2019 levels. But what can we expect, I suppose, from the domestic tourist this year and maybe for the next couple of years?
I think there's a lot of pent-up demand out there, and I think as people are traveling more, they're catching up in terms of with trips and with activities that were deferred, I suppose, for some time. So I think 2022 will be a good year in terms of the activities sector. However, I suppose we need to put that in context of 2019, which was a record year, whereby I suppose that we had 9 million domestic trips. We're going to be well back on that. So I suppose the less people traveling, I suppose the less customers we have, I suppose, for these various activities, and therefore, while numbers will be up and there's a strong rebound, it could take a number of years to get back to 2019 levels.
And do you think then, if we look at the international visitors, do you think there will be a direct replacement, I suppose, of domestic tourists that are leaving the country versus the international visitors that are coming in? We show a long-term trend here.
Yeah, I think the long-term trend, I suppose, is very positive in that it tells us that every time we've had a step back, we've I suppose, progressed further in terms of achieving higher numbers over the course of time, but it takes a number of years. So I think in terms of the fact that we've, I suppose, fallen back such a long way, is that there's a journey to go in terms of, I suppose, getting back to 2019 numbers for international visitors.
So, and ITIC gave us, I suppose, a good synopsis, a forecast going forward, for a base, a negative, I suppose, a base and a positive. And I suppose what this is telling us and what, your opinion as well is that really, 2025, 2026, potentially to get back to the high levels of 2019.
Yeah, I think what we're seeing so far this year is that arrivals are tracking about 35% down in 2019 levels. That would put us, like that continuing for the year, above the 5.8 billion. So it looks like the base case is probably achievable, but still, you're correct. That means that we're not back to 2019 levels probably for 3-4 years. And most businesses we're talking to are kind of looking at, well, what will demand be for our business over the next year or two? And I suppose, how do we cope with the rising costs, which are now in the business?
Yeah, and I think actually, so what you're saying, and I think what this is telling us, this external environment information is telling us, is it's really important to budget and forecast and take these into consideration. In the last 2 years, we had the restrictions in capacities, even, for activities. And now, like as the country has opened up, will we still get the same volume? So the expectation is, if we're not, make sure that you're forecasting right so that it sets a good base for you. So I think that's really valid. So I suppose with our activities, we have very different types of activities. And maybe just to chat through those, and I suppose from the market perspective or from an Ireland perspective, we have different types. And I suppose that what you're saying, or what you see, Aidan, is that obviously the different type of activity impacts on our profitability. So whether it's the size or the type of operation, So we have our, when we think of our typical activities, whether it's yoga or horse riding or golf, they would have been good activities in Ireland. And now we've got some great festivals, so some great activities for cooking and food tastings. And also we're really blessed in this country with the level of water that we have. So from a water sports, sailing and kayaking and paddleboarding, so on and so forth. But these impact, I suppose, the cost base. So the cost base of a boating is going to be quite different to the cost base of maybe a food tasting or a festival. So maybe we'd look at a couple of, I suppose, different types of activities to see what the costs would look like and the EBITDA percentage would look like.
Yeah, so I suppose the scale of business might impact on how profitable they are. But by and large, some of those examples you have may have facilities and they may have a high, I suppose, overhead in terms of property costs. Others may have less, I suppose, facilities, but may have a higher payroll cost. But just to look at, I suppose, two examples and to bring out the point in terms of the increasing cost impact on profit and profitability. The first scenario here, we're looking at a business pre-COVID. It was turning over 500,000. Its costs were 420,000. Its EBITDA was 80,000. So its EBITDA percentage was 16%. So this business post-COVID can't achieve revenue levels achieved in 2019. We can get back to 90% of those. But what's happened since is the cost base of the business is up by 10%. And if that cost base is up by 10% and it can't be passed on in terms of higher prices or cost savings, well then that's going to have a huge impact on the net profit. So net profit would fall to 34,000 euros or 8%. So we can see, I suppose, both, net profit and net profit percentage more or less halving because of cost increases. And a business, I suppose, that had a net profit percentage of 16% means that 84% of revenues coming in are going out in costs. So we can look at a business then, I suppose, which is larger and maybe has a more efficient, I suppose, cost base. A business that pre-COVID had €1 million in turnover, costs were running at 60%, 600,000, and the EBITDA was 400,000, and therefore the EBITDA percentage is 40%. So in this business, it again returns to 90% of pre-COVID levels. Its cost base is up 10% for its level of activity. Its profit is 306,000 euros, down from 400,000 euros, and its EBITDA is 34%. So we can see that, I suppose, the higher the cost base of the business, and the more impact, I suppose, increasing costs will have on that business. And by and large, from the businesses that you described there, Maria, I would say that probably there's more of them in the top category than there would be, I suppose, in the lower category, that in terms of achieving, I suppose, net profit percentage between 10 and 20%, it is probably where you would expect most of those businesses to be.
Yeah, and I think actually that's a really good point, because when you look at that smaller business and the EBITDA, while it's a greater percentage, but it's a smaller amount, but that smaller amount is still extremely important to that business, and even for reinvestment. So let's take a scenario then of one of those types of properties. We have a fictitious business here, but I think it gives a really good idea, and it's what we're seeing in the activity sector. It's a Crowe outdoor activity park, and this is in a good location in regional Ireland. We're looking in that mid bracket, I suppose, revenue perspective of up to $500,000. The facilities require some upgrading. We do see that with a lot of activities. They can be capital intensive, and there's high levels of payroll costs and overhead costs with this business. So let's have a look at its profit and loss account here. We see 3 years. We see 2019, which was a peak year, and then 2021 during COVID, and then the business forecasting out for 2022 this year. What are we expecting here? What do we think that how this business will manage for the year ahead?
So I think it's important just to look at the pre-COVID, I suppose, situation in 2019. So this business, its main income was coming from admissions. It had hires, it had retail and other, but they were 10% of its revenue. Its cost of sales were mainly to do with the hires and retail and other, and that's why I suppose they're at 54,000 euros because it's dealing with a facility where most of the costs are down in overheads. So payroll costs here were 180,000 per annum, 34%. Overheads were 220,000, 41% of revenue. It was making an EBITDA of 81,000 euros and 15% EBITDA or net profit percentage. So during, I suppose, 2021, it was reopened, and it would have been, I suppose, getting back, I suppose, up to scale. It did turnover of 290,000 with a similar sales mix. Its cost of sales were similar. But what's noticeable, I suppose, is the payroll costs were down to 70,000 because the business would have availed of employment wage supports. So that figure, I suppose, has been subvented greatly. Its overheads, because it was operating at a lower basis, were down to 160. And it managed a profit of 31,000, mainly due to payroll supports at 11%. So now they're looking at their budget for 2022. I think because, I suppose, costs have gone up, they're looking at average admission prices increasing from 14 euros to 16 euros, and that seems to be acceptable in the marketplace. The other revenues follow a normal kind of trend. Costs losing a little bit on efficiency there, but what we can see is payroll costs. So even though we would have covered our turnover to 455,000 euros, it's 80% of the 535,000 that we had in 2019. Our payroll costs have, I suppose, come back in, I suppose, at a higher overall percentage. So overall, they're up about 15%. They're at 170,000 euros, and our other overheads have come back in at 43%. So now we're looking at a profit of 40,000 euros when we were making 81,000 euros previously. I suppose this has implications for the business in that is 40,000 euros profit per annum enough to sustain, I suppose, the business, reinvestment in the business, any loans the business might have. And therefore, I suppose there's a task here to manage the profit and loss account to see how can we mitigate some of that fall in profit. How can we get back to 2019 profit levels? Because lower profit means lower cash flow in the business, and that can be a problem over, I suppose, a number of years if it stays at low levels.
Okay, thanks, Aidan. And I think actually what's interesting here is that, on a percentage basis, when we look at those payroll costs, even though we've reduced the actual amount of payroll, on a percentage basis, it's much higher this year than obviously it was in 2019, and the same with costs, with those overhead costs, and that's what it's eating away our profitability or our EBITDA margin. So I suppose what's happened then to the balance sheet, for the last 2 years, how have the impact of that changed the balance sheet? We see 2019 here and 2022, and obviously a point in time as such.
Yes, so in terms of, I suppose, the buildings and equipment here in 2019 were 400,000 euros, and we had a bank loan of 270,000 euros under the liabilities. Roll forward, I suppose, to the start of 2022, and what we can see there circled, other creditors of 30,000 euros. So we brought in some short-term loans at the start of COVID because we were unsure as to, I suppose, how much cash we would need to see through the early parts of the pandemic. The government brought in the capacity to be able to warehouse some taxes, so we've warehoused some taxes. That's why that's gone from 30,000 to 70,000 euros. We can see the asset has gone up by 30,000 euros. So while we had some downtime last year, we reinvested in the asset, and we invested 30,000 because we had some money in the bank. And equally, because we were only paying interest on the loan, we've actually managed to be able to build up some cash, and our bank balance now is 75,000 euros. So we feel comfortable, I suppose, in terms of where we're at. But the important thing here is that we forecast out over the next 2 or 3 years to see, well, how will that €75,000 be impacted by the needs of the business, and also by the fact that we're now a lower profit business potentially than what we were in 2019. And I think that really emphasizes the need to be able to build those profits back up.
Okay, and so let's take a look at that cash flow then, and I suppose as well, having those other creditors of 30,000 and the extra tax liabilities, what we do with those over the next number of years. So not a great picture here, Aidan.
So we can see in 2022, we have EBITDA of €40,000. Now in this business, we invest 3 or 4% per annum back into the facility. That's going to cost €18,000. Interest of the loan is €9,000, and our loan capital is €16,000. So what we can see is in terms of the needs of the business, and this really emphasizes the difference between cash flow and profit. So while we're making €40,000 in profit, actually we have a negative cash flow in the year of 3,600. Our opening cash is €75,000 per the balance sheet. We have to deal with, I suppose, the money we brought in at the start of COVID and repay those short-term loans. So we're going to pay back 15,000 this year and 15,000 next year. And equally, we have to deal with the warehouse taxes. We've got to bring that down by €40,000, and we're giving 26,000 in 2023 and 14,000 in 2024. So we can see that in terms of the business itself, we've gone from having a comfortable position of €75,000 to actually having no money in the business if we followed, I suppose, this particular plan. And therefore, we have to look at alternatives. One is, how can we increase EBITDA? Two is, we need to stagger, I suppose, some of the repayments on the other loans or the warehouse loan, and maybe decide, which one of those, do we pay off first, and how long can we maybe stagger the payments on those? Can we spread them over 3 years or 4 years to make sure that we keep sufficient cash in the business to be able to sustain it?
Okay, thanks. And so how do we decide then, so whether we extend the warehouse tax or whether we pay a loan first? Is it based on in your opinion, is it the interest rates or is it the terms that we have on them? What would you suggest?
I think you have to look at both. In this instance, I suppose retaining a cash buffer in the business is important, so the term would become important. But certainly the interest rate would need to be taken into consideration. So if the interest on the warehouse tax was 3 or 4% per annum, well then how does that compare to the interest on, I suppose, the other loan? And I suppose there's trade-offs then, I suppose, that you've got to look at between those. Okay, thank you. So let's get on then to managing cash flow. Obviously, we've talked over the last little bit about, revenues and costs. So your expectation, I suppose, is that there is a potential to increase revenues from a yield perspective. We saw that the average ticket price, increasing from 14 to €16. And I think just to, I suppose, speak about that for a few minutes, really important for businesses, if the demand level isn't there for you, to make sure that you're yielding from a ticket price perspective. So look to other industries to see what they do. The hotel industry is really good at yielding room rate. So can you yield your ticket price? Can you, student discounts, other discounts that you give, can you reduce those in peak demand times when you know that the demand is there, and yield on your ticket price there to really try and drive that revenue up? Because that's hitting the bottom line straight away, isn't it, really, as opposed to the variable costs that you might have if it was an extra customer. So really trying to look at that. And then I suppose costs, obviously you've mentioned a number of costs, Aidan. So let's talk about those, I suppose, a little bit more, what we're expecting this year, and maybe going into not just this year, but into the next couple of years, what costs we're going to see increasing and maybe maintaining at a higher level. Yeah, and I think in terms of the payroll cost, what we're seeing is that they're probably 15% higher than they were in 2019. So again, there's going to be continued, I suppose, pressure, I think, in and around payroll costs. So we need to be mindful as to what level of price increases are we achieving versus our cost increases. Energy costs are increasing at 20 or 30% per annum, and therefore that's going to eat into our profit and our cash flow, because that's way in excess of any, I suppose, pricing increasing that we might be able to get in the marketplace. And similar with insurance for a business kind of in the leisure sector. So I suppose the question for us, look, is can the increased costs be passed on? I think the answer there is some can and some can't, but really puts, I suppose, an onus on us to look again at the business and say, well, how can we make the business leaner? How can we take some costs out of the business? And if we have to increase prices, how can we do it in a way that we're not firing customers or losing customers?
Okay, thanks. So maybe let's talk through that a little bit. Like what can activity businesses do to reduce their costs, or maybe to manage this year, try and maintain their EBITDA, try and grow their EBITDA, and going into the next couple of years?
I think having, I suppose, the information and the detailed information on costs is the first thing. We need to know exactly what we're spending money on within the business. So what's being consumed within the business. So we need to figure out what are the drivers of each of those costs and look and see, can we reduce, I suppose, some of that consumption. So I suppose, energy was the one we picked on earlier on. Can we look at, our light and heat costs? Can they be reduced in some way? I suppose for a lot of these businesses, water could be an expensive cost. Are there ways that we can reduce water that's being consumed within the business? So I think we pick the bigger costs. We look at, I suppose, the quantum that's being consumed within the business, and we look at saying, well, what can we do to change how the business is operated so that we're consuming less?
Okay, I think there's some valuable points there. And just going back to the sustainability piece, because you talked about that earlier. So for activity businesses, lots of hotels, for example, taking that sector as a good example, really made some internal changes, small changes, whether it's, changing to LED light bulbs, but now they're at the second stage of now looking at bigger ticket items. So like if an activity was to say, well, look, could I get some solar panels? Would I have electric charging stations? Would I have electric vehicles? Like what can I do? Like that's a big ticket investment, and especially if cash flow is tight, how do they make that decision?
Yeah, I think you have to look carefully, and I suppose what we have here, I suppose, on the page are kind of 4 levers in total as to how to mitigate, I suppose, these higher costs coming in. Pricing, we're saying, is one of the 4 levers, but one of the other is in terms of knowing, I suppose, where to invest and how to reinvest in the business. And I suppose looking at, the reinvestment in terms of future cost savings. So we know the initiatives that you mentioned there have paybacks probably of 1, 2, 3 years. With energy costs higher, those paybacks might even be shorter. So look at each of those and rank them in some way. But I think maybe putting the priority on the sustainability agenda can have quick wins, I suppose, and help improve, I suppose, that profit margin and those profit levels, because these are recurring savings into the future.
Okay, I think that's valuable. So I think return on investment is key. So in any of these decisions, when you're looking at your investment, no matter if you think it's going to be a cost saving investment or a revenue generating, it's to make sure that you're looking at the return on investment. Okay, so maybe Aidan, we'll look at some next steps or some key actions for activities, what they can do. So preserve margin, but understand value. Like you and I have discussed this about the hotel, tourism and leisure sector as a whole. Really understand the value of every cost item that you have in your business. Like what value does it bring to you? Are you getting the most value out of it? I think, if it's your EPOS system, for example, or if it's your ticketing system, are you using that to the benefit, or are you getting the benefits out of it? Even looking, like you said earlier, tracking some KPIs, looking at those metrics. Cost management will be ongoing. I think that's safe to say for the sector. Really look at your costs on a regular basis and every cost that you use. Project out and forecast. And I, meet with a lot of activities, and they don't always do this. You might do a budget once a year, but forecasting is real time. You're looking at real costs. Lots of times when we look at our budgets, it's in the past, it's historic. So this is real time costing, forecast out what's it going to look like and how you're going to manage that. That can give some good information. Pass costs on where appropriate. I think we had talked about this a little bit earlier. You asked the question, can they? And it depends, I think, and as well, going back to the value proposition, what is your value proposition? So understanding that you're giving to the customer. This was your suggestion, Aidan, and appoint a spending controller. And I would have said, is that not the accountant or the financial controller? What do you mean by this?
I think in terms of, most, I suppose, businesses believe that their cost base is pretty much in order. But we've looked at the businesses and we're kind of saying, well, if your profit is 15%, that means your cost base is 85%. So there's always going to be scope, I suppose, for finding savings and reducing, I suppose, the consumption of items within the business. But very often it just needs a fresh pair of eyes. So somebody else senior in the business, and ask them to go through, I suppose, what we're spending money on in the business on a line by line item, bring some fresh thinking to it. And I think we'll find new ways of doing things, and we'll avoid doing certain things that we shouldn't be doing that are costing us money. We'll eliminate a number of things, and we might outsource a number of things. So that questioning attitude by having a fresh pair of eyes looking at spending will be very important.
I think that's a really good suggestion, and probably a very simple suggestion that can be, taken action on immediately. And that I think you're right. If you think about it from, that high level of cost, if you can take a few cents off your costs, I mean, cumulatively, that has a big impact. And then finally, draft a cost mitigation action plan. And what do you mean by that, Aidan?
I think when we sit down, I suppose, with businesses and we look at their costs and their cost base, in order, I suppose, to affect change, the one big thing is that the action plan needs to be committed to writing. Somebody needs to take ownership of it, and the actions, I suppose, need to be set out. But it also, I suppose, needs to gather in information. So it's got to find the means of measuring costs, of tracking costs in real time and reporting them, so everybody in the business knows the impact of consuming of costs on the profit and loss, and therefore is focused, I suppose, on using less in the business, making savings, which ultimately will help, I suppose, get that profit back up to the higher levels, and get us back to a point where I suppose the business is more sustainable going forward.
Okay, I think those are some really good examples. I think quite practical, and certainly some good takeaways. So I think, thank you very much. And I think we'll go back to Aileen now. Thank you.
Thanks, Aidan and Maria. And just to finish up, I'd just like to thank everybody for listening today. Just to let you know, our next webinar will be taking place in the autumn, where we will delve into more issues and topics that are facing you at that time. Thanks a million to Crowe and Aidan and Maria for a really informative session and all of those practical hints and tips and really great advice for businesses. And lastly, from myself, please keep an eye on our Business Supports Hub, which is constantly being updated, as well as our national schedule of supports, where you will find all of your training needs. Looking forward to seeing you next time. Thank you.